Hi everyone, welcome back to another video from Rookie Investor. In today's video, we will talk about how to evaluate a stock using all the important ratios. We will focus on 5 parts to evaluate the stock: valuation, profitability, liquidity, debt, and efficiency. I will use a real stock example and I will go over step by step on where to locate the numbers needed and how to calculate the ratios plus the ideal values for each ratio. To start, I will head to TradingView and pick Apple as the stock to evaluate, but you can apply the same steps to any stock. That is the purpose of this video. When you start evaluating a stock, the first and most important part you want to analyze is the financial statements of the company. To find the financials of the company, click the Financials tab on the toolbar and then click Statements. There are 3 key financial statements you need to read and analyze: the income statement, the balance sheet, and the cash flow. Given how important each one is and the time it takes to read and analyze them, I have created separated videos for each one of them. You can find the videos on the cards or in the description below the video. All the ratios we will calculate, evaluate, and analyze today are given by multiplying or dividing numbers we will find on these 3 statements. Having said that, let's proceed to evaluate the Apple stock. As mentioned, I always begin by reading and analyzing the financials. Then it's time for the valuation of the company, and to do that, you need to calculate certain ratios such as the price to earnings ratio. The price to earning ratio is the ratio for valuing a company that measures its current share price relative to its per share earnings. The ratio is used for valuating companies and to find out whether they are overvalued or undervalued. To calculate the price to earning ratio, you need to divide share price with diluted earnings per share. Using Apple stock, we can find the stock price on the board and the diluted earnings per share in the income statement. If we do the calculation, the number we will get is around 24, as I divided 147 with 6.05. Always use current numbers, which is the TTM or trailing 12 month. Investors and analysts consider stocks which have a price to earning ratio of 50 or above to be an overvalued share, while a stock with a price of earnings ratio of 10 or below is considered undervalued. Another important ratio to calculate while valuing a company is the price to book value. The price to book value is calculated by dividing a company's market capitalization by its book value of equity, or as also known, shareholders' equity. Also, the price to book ratio can be calculated by dividing the latest closing share price of the company by its most recent book value per share. Let's calculate the price to book ratio for Apple. The market cap is 2.35 trillion and the shareholders' equity, which can be found in the balance sheet and is the total assets minus total liabilities, is 58.11 billion. If we do the calculations, the result we get is around 40. A price to book ratio that's greater than 1 suggests that the stock price is trading at a premium to the company's book value. For example, in Apple's case, that it has a price to book value of 40, it means that its stock is trading at 40 times its book value. As a result, the stock price is considered overvalued relative to its assets. But for large cap stocks, that is quite common, as investors are willing to pay a premium to invest in these companies. For companies that pay dividends, we need to take that into account valuing the stock. For those not familiar with the term, a dividend is the distribution of a company's earnings to its shareholders, and it's determined by the company's board of directors. Dividends are often distributed quarterly and may be paid out as cash or in the form of reinvestment in additional stock. If a company pays dividends, we need to calculate the payout ratio and the dividend yield, which equals the annual dividend per share divided by the stock's price per share. TradingView is already providing this number for us, which is great. For Apple, the dividend yield over the years is in decline, and from 1.73 in 2015, now it's 0.58. Overall, a dividend yield that is between 2 and 6% is considered ideal. However, it varies depending on market conditions. The payout ratio shows the proportion of earnings a company pays its shareholders in the form of dividends, expressed as a percentage of the company's total earnings. To calculate it, you need to divide the total dividends being paid out with the next income generated. Once more, TradingView has done all the work for us. The payout ratio for Apple in 2021 was 15.14%. A dividend payout ratio of 30 to 50% is considered healthy, while anything over 50% could be unsustainable. The next part on evaluating a stock is to check its profitability. To determine profitability, we will check three metrics: the return of assets, the return of equity, and the net profit margin. Starting with the return of assets, it refers to a financial ratio that indicates how profitable a company is in relation to its total assets. We use return of assets or ROA to determine how efficiently a company uses its assets to generate a profit. To calculate return of assets, we need to divide net income with total assets. You can find the total assets on the balance sheet and the net income on the income statement or cash flow statement. The metric is commonly expressed as a percentage. In Apple's case, and for the year of 2021, the numbers to use are 94.68 billion divided by 351 billion. The number you will get is 0.28 or 28%. A return of assets of over 5% is generally considered good and over 20% excellent. In case of Apple, it's 28%, which is considered excellent. Keep in mind though that return of assets should always be compared amongst firms in the same sector. In general, the higher the return of assets means a company is more efficient and productive at managing its balance sheet to generate profits, while a lower return of assets indicates there is room for improvement. Return of equity is a ratio that provides investors with insights into how efficiently a company, or more specifically its management team, is handling the money that shareholders have contributed to it. In other words, return on equity measures the profitability of a corporation in relation to stakeholders' equity. To calculate the return of equity, you need to divide the net income with the shareholders' equity. In Apple's case, for 2021, the numbers are 94.68 billion divided by 63.09 billion. The number we get is 1.5 or 150%. A return of between 15 to 20% is considered good. However, the higher the return of equity, the more efficient the company's management is at generating income and growth from its equity financing. Return of equity is often used to compare a company to its competitors and the overall market. The metric is especially beneficial when comparing firms of the same industry, since it tends to give accurate indications of which companies are operating with greater financial efficiency. To note here that you can find all these ratios on the statistics page. So let's compare Apple to Microsoft since they are on the same sector. As you can see, for the year of 2021, Microsoft has a return of equity at 47%, which is high, but quite lower than Apple, meaning Apple is more efficient at generating income. Last, the net profit margin, which is also known as profit margin, is the ratio used to calculate the percentage of profit a company produces from its total revenue. It measures the amount of a net profit a company obtains per dollar of revenue gained. To calculate the net profit margin, you need to divide the net income by total revenue. In Apple's case, these numbers are 99.63 billion divided by 387.54 billion. The number you will get is 0.257 or 25.7% if we express it in a percentage. A good net profit margin will vary considerably by industry and size of business, but as a general rule of thumb, a 5% margin is low, 10% net profit margin is considered average, and a 20% margin or above is considered high. The higher the number, the better. Moving on, we need to check the liquidity of the company. Liquidity for companies typically refers to a company's ability to use its current assets to meet its current or short-term liabilities. Basically, if the company has enough money to pay its current bills. A company is also measured by the amount of cash it generates above and beyond its liabilities. There are two key ratios to measure a company's liquidity: the current ratio and the quick ratio. The current ratio, which also is known as working capital ratio, measures the liquidity of a company and is calculated by dividing its current assets by its current liabilities. The term current refers to short-term assets or liabilities that are consumed and paid off in less than 1 year. The current ratio is used to provide a company's ability to pay back its liabilities, debt and accounts payable, with its assets, cash, marketable securities, inventory, and accounts receivable. In Apple's case, for 2021, these numbers are 134.84 billion divided by 125.48 billion. The number we get is 1.07. A company should ideally have a ratio greater than 1, meaning they have more current assets to current liabilities. However, it is important to compare ratios to similar companies within the same industry for an accurate comparison. The quick ratio is identical to the current ratio, except the ratio excludes inventory. Inventory is removed because it is the most difficult to convert to cash when compared to the other current assets like cash, short-term investments, and accounts receivable. In other words, inventory is not as liquid as other current assets. To calculate the quick ratio, you have to subtract inventory from current assets and then divide with current liabilities. So in our case, we need to subtract 6.58 billion from 134.84 billion, which gives us the number of 128.26 billion, and then have this number divided by 125.48 billion. The final result we get is 1.02. A ratio value of greater than 1 is typically considered good from a liquidity standpoint, but this is industry dependent as well. The next part to focus on is debt. Debt is the sum of money borrowed and is due to be paid. To evaluate a company in this department, we need to calculate the debt to equity ratio and the interest coverage ratio. Debt to equity ratio is an important metric in corporate finance, as it measures of the degree to which a company is financing its operations with debt rather than its own resources. It is also known as risk. Debt to equity is calculated by dividing a company total debt by its shareholders' equity. In Apple's case for 2021, we need to divide 136.521 by 63.09. The number we get is 2.16. Generally, a good debt ratio is around 1 to 1.5. However, the ideal debt ratio will vary depending on the industry, as some industries use more debt financing than others. To note here that capital-intensive industries like the financial and manufacturing industries often have high ratios that can be greater than 2. Moving on to efficiency, here we will have to calculate two metrics, asset turnover ratio and inventory turnover ratio. Asset turnover ratio is the ratio between the value of a company's sales or revenues and the value of its assets. It is an indicator of the efficiency with which a company is deploying its assets to produce the revenue. For this reason, asset turnover ratio is a very important metric evaluating a company's performance. To calculate the asset turnover ratio, you need to divide net sales or total revenue with the average total assets. To estimate the 2021 asset turnover for Apple, you need to take the total revenue from the income statement, which is 365.82 billion, and divide it by the total assets average of the last 2 years. That would be 351 plus 323.89 billion divided by 2, which gives us 337.445 billion. If you then divide 365.82 by 337.445, you will get 1.08, which is the asset turnover ratio of Apple for 2021. The higher the ratio, the better it is for the company's performance. Asset turnover ratio can be different from company to company. In the retail sector, for example, an asset turnover ratio of 2.5 or more could be considered good, while a company in the utility sector is more likely to aim for an asset turnover ratio that's between 0.25 and 0.5. Inventory turnover ratio refers to the amount of time that passes from the day an item is purchased by a company until it is sold. It measures how efficiently inventory is managed. It is important to achieve a higher ratio here, as a higher turnover rates reduce storage and other holding costs. To calculate the inventory turnover ratio, you need to divide cost of goods sold by the average inventory. Once more, let's use Apple's figures. Head to the income statement and we can see that the cost of goods sold for 2021 were 212.98 billion. For the average inventory, head to the balance sheet. The numbers we will use are 6.58 and 4.06. Add these numbers and divide them by 2. You will get 5.32 billion. Now we can divide 212.98 by 5.32 billion and we shall get 40. That means that the inventory turnover ratio for Apple for 2021 was 40. For most industries, the ideal inventory turnover ratio will be between 5 and 10, meaning the company will sell and restock inventory roughly every 1 to 2 months. It is vital to compare the ratios between companies operating in the same industry and not for companies operating in different industries. So let's check Microsoft inventory turnover ratio. I will not calculate that number. As I mentioned prior, you don't have to calculate them at all. All these ratios on TradingView and other websites are provided. Having said that, we can see that the Microsoft's inventory turnover is 19.65. Between the two companies who operate in the same sector, Apple is doing a way better job, but to be fair, Microsoft's ratio is extremely good as well. By now, you should have a very good understanding on how to evaluate a stock, or at least to what key metrics you need to look. To mention once more that it is important to learn how to read and analyze the three parts of the financial report: the income statement, the balance sheet, and the cash flow. Combining the financial report analysis and the valuation, profitability, liquidity, debt, and efficiency evaluation we covered in this video, you can reduce the risk of making a mistake picking a stock. I hope this video really helped you get familiar with the most important ratios evaluating a stock. I will make more videos about stock investing, so make sure you hit the subscribe button, and of course, if you like the video, please smash the like button. It will mean a lot. Thank you for watching. See you in the next video.